Welcome everybody to our first improvised lecture. I hope it's gonna work. So initially I thought that we're gonna do 50-minute lectures, but we were advised to keep it short and keep it low low video quality, so that those of you who have maybe lower internet quality, so you can watch it. So we'll see. This is the first experimental version, and you let me know how that works for you and whether you want more of it or less of it. You can see that this is our clearly improvised lecture room, so hopefully it's going to work for us. What's the main thing I want to talk about today related to lecture 18 is estimating stock prices. Now that's going to be a fun thing for us to do, given the stock market that is going crazy these days. So so I want to do, because it's going to be short, I want to do something that's the essence of the lecture, and that is the constant dividend growth model. Now, constant dividend growth model simply assumes that you're going to buy a stock and you're going to hold it forever, and the only cash flows that you have from it are dividends. And so if we wanted to represent that on a timeline, we will put it like this. Time 0, that's now. Period 1, 2, 3, 4, 5, and so on, forever like that. Now, these periods could be quarterly, could be monthly, could be yearly, it doesn't really matter. The main thing is it happens like that forever. Now, my favorite company, Coca-Cola, of course, the most recent dividend per year was $1.6 per year. So if this is year 1, year 2, year 3, let's assume that this company is going to be paying dividends of $1.6 per year from now until forever, which means growth of 0. Now let's see, 1.6, 1.6, 1.6, 1.6, 1.6, and like that forever. Now this looks very familiar to you, hopefully. It is a perpetuity. Now, how much would you pay for this perpetuity, or how much would you pay for that stock? Basically, that's the question. This stock will give you these cash flows from 1 year from now until forever. And you may be thinking, this is a silly time to think about this question when everything's going crazy. Actually, this is a very good time to think about it, because we can actually analyze some of the things that are going crazy right now. So, what is the price that you would be willing to pay at most? Given the theory, it would be the present value of all these future cash flows that you're going to get from this stock. So price is going to be the present value of these cash flows, and we know the present value is going to be present value of perpetuity, which is 1.6, the cash flow, divided by now this perpetuity doesn't grow, or grows at the rate of 0, so we can do R minus G, which is, this is the opportunity cost of capital, or return on capital, and this is the growth rate. Now for us this is going to be 0, but we can examine the other growth rates if we use this equation. So what R should we use for Coca-Cola? The most commonly used R for companies is what would be historic return on their capital, or weighted average cost of capital. So let's say for Coca-Cola, just for the sake of argument, and it's actually pretty close to what it should be, 3% per year. It's a very big company, relatively stable, so we wouldn't expect very high returns on capital. It's not growing very quickly. So let's say 3% per year, so that's 0.03. Now this is going to be 0, so 0.03, not 0.06, 0.03. So so let's try to see what share price this would give us, or how much we would be willing to pay for this. Now let's see. Equals 1.6 divided by 0.03, and it says 53.3. Now that sounds 53.3. That sounds familiar because Coca-Cola share price was 51, 53, 57 in the recent, not most recent, but recent weeks. So that seems reasonable that the company is going to grow at the rate of 0, which is usually the case for old mature companies. And this is a standard, very safe assumption about opportunity cost of capital or return on capital. So it seems that it worked for us. It seems that if the investors are using this same model, then the price that was on the market last month maybe was actually consistent with this. Now, the current price, not the current price, I was too scared to look at it today or yesterday. The last time I looked at it was $48 or $47, so went down compared to this. Now this is a historic return, so this didn't change. This is their historic return on capital. So what could have changed? Well, this didn't change because this is again the last dividend that they paid. We only assume that it's going to grow at the rate of 0. So what might have changed in the minds of investors is probably this. So growth rate of 0 may be too high. It looks like that to get a number 40, let's say 47, which is, let's say, the current price. The price went down from 53 to 47. To get this result from this formula, this number on the bottom has to be bigger. And this is, again, the first dividend from now until forever. This number should be bigger. How can this number be bigger? Well, if g is negative, then this is going to be 0.03 minus something, which is plus something. It's going to make this number bigger, and it's going to make this number smaller. And we could actually figure out how negative do the investors think the growth rate of Coca-Cola in the future is going to be to get this price of 47. If the price goes further down, that may be an indication that the investors think that the growth rate is going to be even more negative in the future. So the first dividend might be 1.6, but maybe they're expecting 1.5 here, maybe 1.4 here, maybe 1.3 here, maybe 1.2 here. And if that's the case, then we're going to have a negative growth rate and a smaller price here. We don't really want to calculate that exact number, but maybe we could give you that as your unofficial homework to calculate that number. So let's see how this looks.